Since COVID, we've seen that China probably has understimulated its economy, and we've been a bit surprised that they haven't done more to get their economy moving. We are starting to see now more broad-based stimulus measures from China to try to really get consumption activity moving within the economy. So it's going to be different to what it looked like in the last 10 and 20 years, where it was really about iron ore and the big build out of infrastructure in cities. They're now trying to evolve and they're trying to move further up the value chain. And so they're trying to get more of a consumption-based economy, and that's going to be more relevant for things like EVs and consumer products within the Chinese economy. And that's obviously good for copper.
Iron ore prices are falling. What's behind that?
Well, look, iron ore, obviously we've had a period of 20 years now where the iron ore price has been very good. We are seeing that just the property markets in China have really not recovered at all from those pre-COVID years and the big boom years, and so that will weigh on iron ore. We've seen that port stocks as well remain a little bit high. They have drawn down a little bit in recent weeks, but they still remain historically quite high. And then we've got some big new mines coming on as well over the next 1 to 2 years. So Samandu in Africa is a big one for Rio. That's going to really increase the supply side of the equation. So we're probably seeing a little bit of softness in the iron ore market on the back of all of those reasons.
We've seen gold rise to an all-time high in recent days. How much of that is a symptom of the rising uncertainty and volatility that we're seeing in markets?
Yeah, absolutely. I mean, at the moment, as I say, the markets can deal with bad news, the markets can deal with good news, but the market struggles to deal with uncertainty. And at the moment, we just have a lot of uncertainty in financial markets about the long-term policies for coming out of the US. And so gold is the natural beneficiary of this. When you're unsure what to do, having a little bit of gold in the portfolio is very good.
And how much higher can it go?
It's impossible to know. What we do know is that commodities typically overshoot on the downside and they overshoot on the upside. Typically, towards the end of a commodity price cycle, you get what's called a blow off top, where you get really frenzied buying and you see some really big volatile price moves in the commodity. We haven't really seen that yet, so I still think that certainly over the next 3 to 6 months, gold looks like a good place to be and probably can continue to push higher.
With the US tariffs, we've seen modelling showing it will lead to a, quote, manageable 0.02% reduction in Australian GDP. But what sorts of broader impacts are they having on markets that might have flow-on effects to the Australian economy?
Yeah, I mean, that is the big question at the moment for financial markets, because firstly, we don't know where the US stops. With their tariff policies, it seems to be changing almost day by day and week by week. We do expect now that we're going to go through a period of quite soft economic data coming out of the US, and that will have secondary effects on really all global economies. And so we do expect the data to continue to soften unless the US government really does start to slow down their rate of change and the nature of the tariffs that they're implementing. I mean, we know that Trump's a market animal. We know that if the markets do start to throw a tantrum, or if the economic data really drops off a cliff, we'd expect him to pull back a little bit from how aggressive he's been. But he certainly has been more aggressive than what we anticipated at the start of his presidency. And we think this is going to have some quite large ramifications, certainly over the next 3 to 6 months in the economic data.
Giuliano Sala Tenna, thanks for joining me.
Thank you.